In September 2025, one company reported managing more than $1 trillion in assets, and in just a single quarter it raised $30 billion and deployed $23 billion into deals. That's not just money. That's the power to decide what gets built, what gets sold, and who pays the toll just to live a normal life. The part that should make you uneasy is this. Most people have never even heard of them. Even though you might already be paying them every month, so where exactly are you paying through? This $1 trillion isn't the same kind of trillion you associate with a phone company. In 2025, they ran a machine that harvests fees from long-duration cash flows, $754 million of fee-related earnings in a quarter, with roughly a 58% fee-related margin at the corporate level. That's not just a pretty report. That's a business model that feeds on the simple fact that people can't stop using electricity, can't stop going to work, and can't stop needing space to live and operate. The real question is, where are you trapped inside that model? Their name is Brookfield Asset Management. In 2025, headquartered in New York, they said outright they manage more than $1 trillion across infrastructure, energy, real estate, credit, and private equity. This isn't a consumer brand. It's a control panel for the physical world. Power stations, pipelines, buildings, ports, warehouses. If you want to understand what real power looks like, look at what doesn't have a logo in your hand, so what invisible lever is shaping your life. Now rewind. In 1899, Brookfield's predecessor was founded in Brazil to run streetcars and electric power in São Paulo. That's not just an old origin story. That's the first lesson. Whoever controls the switch controls the city. By 1940, that system was recorded as having more than 50,000 employees and supplying roughly 2/3 of Brazil's electricity. That's not just scale. That's a historical habit. Attach yourself to essentials, then force the rest of society to adapt. And the question is, what does that habit become when it grows up? Cut back to the present, and you'll see the trick that keeps ordinary people asleep. In 2024, Brookfield described having around 2,500 investment professionals, but alongside that, roughly 250,000 operating employees across more than 30 countries. That's not just finance staff. That's a living, breathing operations machine. When you call it the market, they call it the system. And when the system hits a crisis, who gets protected first? Pause for a second. Look at your electricity bill. In 2024, their renewable arm reported about 46,200 megawatts of operating capacity. That's not just a big number. That is millions of homes that can stay lit and millions of political outcomes that can swing when power prices spike. In that same year, they reported normalized long-term generation of about 121,200 gigawatt hours. That's not just output. That's why the biggest buyers come knocking. And the question is, who is signing the future on your behalf? In 2024, Brookfield announced a partnership to deliver more than 10.5 gigawatts of new renewable capacity for Microsoft between 2026 and 2030. That is not just green branding. That is big tech needing electricity the way it needs oxygen and the seller of long-term power. Becomes a kind of shadow state at the negotiating table. You think power struggles only happen in government. A lot of them happen inside power purchase agreements. So where does that leave ordinary people and small businesses when the table is already set? But power doesn't just sit in electricity. It sits in land and what stands on it. Then reality hit in 2023. Canary Wharf recorded major office value write-downs, with more than £900 million marked down and the overall portfolio valued around £6.8 billion. That's not just a paper loss. That's how interest rates and the office crash become pressure on tenants and workers. When valuations swing, owners do what they always do: restructure, refinance, and push risk downward. The question is, who lives on the bottom floor? The bottom floor is usually the public, even if nobody says it out loud. If you want to see how this power touches skin, look at Manhattan. In 2018, Brookfield announced it acquired 100% of the long-term leasehold rights to the office portion of 666 Fifth Avenue, about 1.5 million square feet. That's not just real estate. That's a symbolic choke point in the richest city on earth. The lease is 99 years. That's not just long. That's a reminder they're playing on a timeline politicians can't match. And over 99 years, who do you think is forced to adapt? In 2020, a U.S. Senate investigation letter described the deal as worth about $1.28 billion for that 99-year lease. That's not just a payment. That's a ticket into the space where money, politics, and public image get mixed together. And by 2025, business coverage described Brookfield as having invested roughly $1.7 billion total into the tower, now rebranded with average rents that could reach around $135 per square foot. That's not just rent. That's how a city gets resorted by who can afford to exist near the center of gravity. So whose city do you think you're living in? Here's what makes me angry. This system wins not because it's secret, but because it's legal and boring enough that you ignore it. In 2024, Brookfield reported it signed nearly 27 million square feet of office and retail leases in a single year. That's not just activity. That's the heartbeat of jobs, stores, services, and ultimately your paycheck. When a firm negotiates at that scale, it doesn't need to control you directly. It just needs to control the space your life has to pass through. So which door is quietly locking behind you? You might push back. At least they bring capital to build what society needs. In 2024, Brookfield Asset Management said it raised more than $135 billion of capital and deployed about $48 billion into assets. That's not just growth. That's the capacity to substitute for public budgets when governments are constrained. And I know you're thinking, if they build clean power and better infrastructure, what's the problem? In that same year, an industry report noted Brookfield Renewable brought a record roughly 7 gigawatts of new capacity into operation. That's not just an achievement. That's why people forgive this model until they realize they re-becoming tenants inside their own country. And will you notice in time? Because this is the survival warning when electricity becomes scarce and housing becomes unreachable. The winner isn't the one who talks best. The winner is the one who owns what you can't stop using. In 2025, they could issue $750 million of 30-year debt at a 6.077% rate to keep buying and recycling capital. That's not just a bond deal. That's proof they can pull the future into the present, to buy the present, and then make you repay that future through bills and rent. And if you want to understand why this kind of power almost always wins, you have to watch how it turns public life into an investment product right in front of you. A giant that owns power plants and prime real estate does not need you to know its name. It just needs you to keep paying for access, and that is where the story gets sharper. In 2024, Microsoft signed a deal described as about $10 billion with Brookfield to help develop 10.5 gigawatts of new renewable capacity by 2030. That is not just corporate sustainability theater. That is a private actor sketching out the energy map your future bills will live inside. And notice the move. It is not buying electricity the old way, day to day on a grid. It is trying to lock supply years ahead, because the world is running into a hard constraint. Not enough clean power, not enough fast, not enough where the demand is exploding. The twist is that the constraint is now being solved by people who do not run for office, and that changes what survival looks like. Then in 2025, that same universe got even louder. Brookfield and partners announced a partnership framed around at least $80 billion of new Westinghouse reactors to be built across the United States. That is not just a big number. That is a signal that energy planning is getting pulled into private deal rooms, because governments want speed and scale, and private capital wants contracts that behave like gravity. This is the rule of three that keeps repeating, even when the names change. Power, property, and permission. Not permission like a vote. Permission like a concession, a lease, a rate case. A contract clause that lets cash flow keep walking toward the same pocket, even when the world gets uglier. Now zoom in on the machine, because this is where most people get tricked by the wrong scoreboard. In Q3 2025, Brookfield Asset Management reported $581 billion of fee-bearing capital and more than $1 trillion in assets under management. That is not just size for bragging rights. That is a toll booth business model where the traffic is other people's money. In that same quarter, it reported $754 million in fee-related earnings with a 58% margin at its share. That is not just profitability. That is proof the real product is not an office tower or a wind farm. It is a pipeline of fees that stays alive even when assets wobble. And here is the detail that matters to ordinary citizens. In that Q3 2025 snapshot, 87% of fee-bearing capital was described as long-term permanent or perpetual. That is not a short fling with a volatile market. That is a plan to sit inside essential systems long enough that everyone else has to adapt. You can feel the anger in that, because it flips the moral story people tell themselves. We are taught the system is a tug-of-war between companies and customers. But in the infrastructure world, the contract often makes the customer a captive, and then calls it stability. In December 2022, Brookfield split into two publicly traded entities, with the corporation renamed Brookfield Corporation and the manager listed as Brookfield Asset Management. That is not just corporate housekeeping. That is separation designed to make the fee engine easier to value and easier to scale, while the operating assets keep doing the slow, heavy work in the background. So when you hear the word investment firm, do not picture a trader staring at charts. Picture an organism that can raise capital, buy real-world choke points, and then rewrite how cash moves through your city. In 2024 alone, Brookfield Asset Management reported over $135 billion of capital inflows and $48 billion of capital deployed. That is not just fundraising momentum. That is a pace of buying that can outrun public planning cycles. Then in Q3 2025, it reported raising $30 billion and deploying $23 billion of equity capital in a single quarter. That is not just speed. That is how you turn chaos into market share before anyone has time to argue about it. And this is where power and property fuse into one weapon. Land, grid access, and long-duration contracts become one bundle. If you control the bundle, you are not guessing the future, you are charging it rent. You saw the property side in the most theatrical way back in 2018. When Brookfield acquired a 99-year leasehold on the office portion of 666 Fifth Avenue in New York, a building tied up in a refinancing saga and purchased for $1.8 billion back in 2006 by Kushner Companies. A 99-year lease is not just a long lease. It is a way to control a landmark for a lifetime without buying the whole thing the way the public imagines ownership works. And that is the quiet pattern. People fight over who owns what, while the real power often sits in who controls the cash flow rights. Look at Canary Wharf as a stress test. Then the world changed. In 2023, Canary Wharf wrote off more than £900 million of value, with the portfolio reported around £6.8 billion, and net debt around £3.7 billion, while it secured a £553 million refinancing and reported office occupancy around 91.1%. Those numbers are not just balance sheet trivia. They show you what happens when a giant landlord meets a new reality, and the response is not panic, it is restructure, refinance, and keep control. Here is the point that should make you uneasy. When the bet works, the upside is private. When the bet breaks, the system leans on refinancing, lender support, and sometimes public patience, because letting essential districts collapse is politically radioactive. Stop. Imagine this logic gets applied not to towers, but to daily life. In 2008, Chicago agreed to a 75-year parking meter concession for $1.156 billion, covering roughly 36,000 meters. That is not just a city deal. That is a city selling a slice of time because it wanted cash now. The city got money up front. Citizens got decades of rules written into a contract, including what happens when streets close, when construction happens, when the city wants to change how parking works. It looks like boring administration. It is actually a private claim on public space. Now do the same thought experiment with a highway. In 2006, Indiana leased the Indiana Toll Road for 75 years to a consortium that included a Macquarie subsidiary and Sintra for $3.8 billion. That is not just a big check. That is a state converting future tolls into immediate budget relief. Then in 2014, the toll road operator filed for Chapter 11 bankruptcy. That is not just a business failure. It is the clearest demonstration of the trick. The financial structure can break while the underlying road still matters, still operates, and still collects, because the asset is too essential to disappear. And when an essential asset cannot disappear, the question becomes, who gets protected first when the numbers do not add up? This is why infrastructure investors love inflation linkages and regulatory frameworks. It is not because they are evil. It is because those frameworks turn messy reality into predictable cash flow. Now push this to the most sensitive utility of all, water. In 1989, water in England and Wales was privatized. And decades later, the sector became a symbol of what happens when monopolies and leverage mix. By March 2022, Ofwat data cited in reporting put debt for water utilities in England and Wales around £60.6 billion. That is not just a lot of borrowing. That is a structural decision to load essential services with financial obligations that customers cannot opt out of. Then between 2021 and 2023, analysis based on Ofwat data reported about £2.5 billion in dividends, while net debt rose by £8.2 billion. That is not just shareholder rewards. That is a warning label. Money can be extracted even while the system becomes more fragile. You might be thinking this is all just far away, foreign, and abstract, so let me make it personal in one sentence. I know you are thinking this is finance for other people, not something that decides whether my family can afford next month. Here is the counter-argument, and it deserves to be said clearly. Governments have crumbling infrastructure and limited budgets. Private capital can fund projects faster. Pension funds want steady returns to pay retirees. And when a company like Thames Water serves about 16 million people, you cannot just flip a switch and replace it without chaos. All true, and none of it cancels the risk. Because the problem is not private money by itself. The problem is bargaining power when the asset is essential and the contract is long. If a deal is written so prices escalate while accountability stays vague, citizens lose leverage. If debt stacks up inside a monopoly, citizens become the backstop. If the upside is locked in by fee structures and the downside is pushed into refinancing drama, citizens become the shock absorber. That is why the capital structure details matter more than the slogans. In September 2025, Brookfield Asset Management issued $750 million of new 30-year senior unsecured notes with a 6.077% coupon, and also reported increasing revolver capacity by $300 million to $1 billion. This is not just corporate borrowing. This is how you extend your runway so you can keep buying assets while everyone else is forced to pause. And when you can keep buying during pauses, you do not just survive cycles. You shape what the next cycle looks like. This is also where scale becomes a weapon you can feel, even if you never see the headquarters. In 2025 corporate reporting, Brookfield described more than 2,500 investment and asset management professionals and about 250,000 operating employees spread across more than 30 countries. While its public site describes 50-plus countries, that is not just a big workforce. That is a distributed intelligence network that sees local distress early and moves capital before the headlines catch up. Then comes the credit layer, the part that turns uncomfortable fast. In 2019, Brookfield agreed to buy a majority stake in Oaktree for about $5 billion. And in October 2025, it announced a deal to acquire the remaining 26% stake for about $3 billion, with Oaktree reported around $209 billion in assets as of June 30th. Those numbers are not just M&A trivia. They show a deliberate push into the business of lending against the world. Because lending is how you get paid first. And if you get paid first, you can be patient about everything else, including political noise. Finally, watch how the energy transition narrative becomes a capital magnet. In 2025, Brookfield was reported to have raised $20 billion for a second global transition fund, with more than $5 billion already invested, including a $6.6 billion acquisition of Neoen. That is not just clean energy optimism. That is a play to own the next layer of essential infrastructure while it is still being built. So here is the cliffhanger you should not ignore. If one firm can lock in future electricity, reposition landmark property, scale private credit, and refinance through stress, what happens the next time your city needs cash fast and sells the future in a hurry? Two things can be true at the same time. You can live in a democracy and still spend your entire life paying rent to systems you never voted on. That is not a slogan. That is a business model hiding in plain sight. Here is the part most people miss because it is not dramatic enough for headlines. Brookfield does not need you to love it. Brookfield does not even need you to know it exists. It only needs one thing: your city, your employer, your utility, your pension, your data center landlord, your grid operator, your airport operator, your toll road operator, to keep signing long contracts. That is the quiet superpower. The numbers look like finance. The effect feels like physics. In 2024, they reported over $135 billion of capital inflows and $48 billion deployed. That is not just scale. That is a machine that can keep moving even when the mood of the market turns ugly. And in Q3 2025, they reported a record $30 billion raised in a single quarter, with fee-related earnings of $754 million and a 58% margin. That is not a fun fact. That is proof that the engine is built to run on time, not applause. Now let me hit you with the uncomfortable translation. Every time a government sells a 75-year concession to plug a budget hole, it is not just selling asphalt or steel. It is selling future flexibility. That is why a deal can look like free money in year 1 and feel like handcuffs in year 12. Because the counterparty is not a contractor, it is a system builder. And once a system is built at that horizon, workers, citizens, even elected officials end up adapting to it. Think about the pattern we walked through. In Chicago, meters. In Indiana, a toll road. In England and Wales, water companies loaded with debt while dividends still flow. In Manhattan, a building that changed its name, its tenants, its cash flow, and suddenly the same city that laughed at it now competes to get inside it. Different sectors. Same move. The move is to take something boring, lock in a long claim on the cash flow. Then make the cash flow look safe enough to stack cheaper money behind it. Once that stack exists, the fight is no longer about the asset. The fight is about the contract. And contracts are not romantic. They are brutal. If you are a normal person, you do not get to renegotiate the contract. You get to live inside the outcomes. That is the survival warning. Because the moment your essentials become financial product, your life starts inheriting finance rules. When interest rates rise, costs jump. When refinancing tightens, maintenance gets delayed. When a valuation falls, someone somewhere looks for a lever that still moves. And that lever is usually you, your bill, your rent, your commute fee, your taxes. I know you are thinking, okay, but someone has to own and run these things. So what is the alternative? Fair question. Here is the answer nobody wants because it is not a clean ideology. Ownership is not the only problem. The terms are the problem. A private owner can run a critical asset well or badly. A public owner can run a critical asset well or badly. The difference is what happens when the plan breaks. When the plan breaks in public, the pain is visible and political. When the plan breaks in private, the pain is contractual and slow. It leaks. It shows up as fees, smaller repairs, deferred upgrades, stricter enforcement, higher charges, less slack. You feel it, but you cannot point at it. That is why this model keeps winning. Not because it is always evil, because it is structurally hard to reverse. So what do you do with that right now as an ordinary person? You stop arguing about whether Brookfield is a villain and start measuring the 3 things that decide whether you are about to become a captive customer. First, time. If the deal is 40, 60, 75, 99 years, it is not a deal. It is a transfer of options from the public to the contract holder. Second, exit. If your city cannot exit without paying a penalty that makes exit impossible, the negotiation is over before it begins. Third, transparency. If the operator can move value between affiliates, refinance through layers, charge fees through internal entities, and the public cannot see the full picture, then you are not regulating a business. You are regulating a maze. Here is why this matters more now than 10 years ago. The world is electrifying. Data centers are exploding. Grids are being rebuilt. Energy is being rewired. That build-out will be financed, and whoever controls financing terms will shape the physical world you live in. Brookfield knows this. That is why you see them promising gigawatts to hyperscalers. That is why you see them talk about transition funds the size of governments. That is why you see partnerships framed around nuclear build-outs with price tags that start at tens of billions. This is not a conspiracy. It is the logical end of our own incentives. We demanded lower taxes, better services, cheaper power, faster infrastructure, and we told politicians they get 1 election cycle to do it. So politicians reach for one-time cash, and the firms that can write the biggest check get the longest rights. Then we act surprised when the future arrives and the meter is already running. So let me end with the most important twist. The trillion-dollar company most people never heard of is not dangerous because it is secretly everywhere. It is dangerous because it is teaching the world a repeatable method for turning the commons into contracts, and turning contracts into leverage, and turning leverage into permanence. Power and property are not just things you own. They are things that own you back, if you sign them away long enough. And the next time someone tells you a deal is too technical to understand, treat that as the alarm bell. because the only deals that must stay confusing are the ones that cannot survive daylight.